If you're that guy or gal telling your broker that you just want the cheapest possible policy, then you're going to have some serious problems in your business, and there are going to be a lot of hidden costs that you have to be aware of. So in this video, we're going to go over how to keep your policy premiums as low as possible, but without sacrificing on coverages and quality. So let's get right into this. Coming over to my computer here, we're going to talk about the hidden costs of cheap business insurance and how to avoid them. And the bonus is we're going to be talking about how to keep your premiums low, but without sacrificing coverages. Cheap business insurance is like a dollar store umbrella. It's great until it rains. And the reason that I say that is you don't want to just have a policy for the sake of having a policy. If your vendor or your landlord has minimum insurance requirements that they want you to meet, and you just meet those basic insurance requirements and you're not actually genuinely protecting your business, you can have problems potentially in the future. So what are you going to learn in this video specifically? The first thing you're going to learn is the 5 hidden costs of having a cheap business insurance policy. The second thing you're going to learn is practical tips to avoid paying these hidden costs. And then a bonus tip is how to have the lowest possible premium policy without sacrificing coverages. Hidden cost number 1 is coverage gaps. These are exclusions or limits that leave you exposed when you need the protection the most. So similar to the example that I gave you guys before, let's say, God forbid, the property that you have goes on fire and you have minimum general liability requirements based on whatever landlord agreement you have. So let's say your landlord told you that the minimum requirement is $2 million aggregate, $1 million per occurrence, but you run a restaurant and you have $300,000 in equipment. And on your general liability policy, usually equipment is not just covered off the bat. You're going to have to add that as an additional coverage. But a lot of people want to avoid that in order to save costs, and being cheap could cost you a lot more money because, God forbid, if you have a fire, things happen in business, or somebody comes in and vandalizes your property. Well, now, let's say you're not covered by insurance for that. You're going to have to come out of pocket to recover all of those damages to your equipment. So having coverage gaps and being cheap and then completely missing certain coverages altogether is going to cost you a lot of money in the long run, a lot more than you would pay in premium. So the previous scenario I gave you was a restaurant that either went on fire or got vandalized and wasn't properly covered for their equipment. Another example of this could be a retail store. If they have water damage, for example, and they didn't have any kind of coverages on their inventory, well, let's say the water damage causes them to lose $30,000 worth of inventory. And they had, again, a very low limit general liability policy, $1 million over $2 million, just like their landlord asked them to have, and they weren't covered for their inventory. Why? Because that's an extra coverage and they just wanted the cheapest possible policy. You could see how that could be a problem because now you're going to have to replace that inventory, $30,000 worth, right out of your pocket. Hidden cost number 2 is denied claims. Always read the fine print or work with a broker who explains the exclusions clearly before you sign the agreement with that broker and that carrier. You guys have no idea how often this happens, and I don't want you to be in a scenario where if you ever have a claim, you run into this problem. You'll be surprised by how many things are excluded in your policy right now that you probably do in your business. Contractors, for example, offer many different services. Let's say you're in one niche and you only do plumbing, for instance. Did you know that most standard insurance companies don't allow for the installation of high-pressure boilers? So if you're a plumber and you do something like that, well, if you're working with a standard insurance company like Byberg, for example, or Hiscox, you're going to be fresh out of luck if you have any kind of claim related to high-pressure boiler installations. And you want to make sure that you pick a broker that's very thorough in these things. You kind of want to make sure that you test your broker as well and see if they ask you about all of these details of what it is that you do in your business. I know from experience, my clients actually get annoyed when I ask them all the questions that I do ask, but you should be happy when your broker asks you all these questions because you're going to know that you're properly covered and the carrier that they find for you actually accepts and allows every single product or service you sell. So that, God forbid, if there's any claim related to the product or service that you sell, you will be covered within your policy. And that brings me to this page right here. If you guys need any help from a broker who actually cares about your business and actually wants you to be properly protected for the lowest cost premium and give you the best of both worlds, then book a call with us at quotes.commercialinsurance-io/total risk protocol, and we'll see how we can help you out. Hidden cost number 3 is insufficient limits. Low coverage equals you pay the difference. So we kind of brushed over this in coverage gaps, but having insufficient limits is a little bit different. So for example, if the industry and or the region that you operate out of has high average claim amounts, you don't want to have low policy limits. So for instance, this happens very often to the industries that I told you about in the beginning of this video for coverage gaps and in similar scenarios as well. So instead of a general liability policy, let's say even if you do have a business owner policy, which combines general liability and property coverage, a lot of the time the property coverage is just not at the limit that you need it at. And this happens for a couple of different reasons. For example, you may have bought more equipment over time, and let's say you were only covered for $100,000 worth of equipment loss, but now you have $300,000 worth of equipment. Well, if you have $300,000 worth of damage, you were only covered for $100K, you have to come out of pocket $200,000. Happens so often, and this is because brokers and also clients alike don't review their policies every single year. And also, a lot of the time, having a non-proactive broker could be the make or break in these type of situations, because the proactive broker will actually ask you every single year, hey, your policy's about to renew, let's go over this. Have you bought any new equipment? Have things changed? Did you hire new employees? Have you signed a new lease agreement? And they go over all the major changes in the business to see if any kind of coverages need to be changed. And that smoothly brings us over into hidden cost number 4. Not only is it bad to not have a proactive broker, you can have a neutral one that's kind of reactive, which is all right, I guess, and you kind of don't want that either. But having an unresponsive broker is completely terrible, because a slow response can delay your coverage and claims. And in the case of industries like contractors, it could also make you lose customers too. Also, if you're a contractor, a really good tip is you always want to ask about response times and COI turnover from the potential broker that you're going to work with. If the broker that you're working with has terrible response times and terrible COI turnarounds, you want to get rid of them as soon as possible. I've spoken to so many clients who have had previous brokers literally make them lose customers because their COI turnaround time is so slow. It's a very big problem. And moving on to the 5th and last hidden cost is long-term costs of frequent switching of brokers. Frequent moves of brokers, higher long-term premiums. Obviously, if you have a very good broker, you want to stick with them as long as possible. If you have a very bad one, you want to move as soon as possible. A lot of the time, people think that by having many different brokers do many different quotes for them is actually going to save them money. But that's contrary to your belief. The reason why is because a lot of these brokers are going to go to the same exact carriers, give them slightly different bits of information because you probably supply them with slightly different bits of information. They all go to the same 4 or 5 carriers that you match industry-wise for, and it's really going to hurt your relationship with the carriers, and you're never going to build a long-term relationship with a good broker. What you're looking for in a broker is someone who cares, someone who's proactive, someone who reviews your policy with you annually and sees, hey, coverage-wise and premium-wise, are we at the levels that we're supposed to be? If we're not, what are we going to do next? Are we going to move to the next carrier? Are we going to raise your coverages because you had major changes in your business? You're supposed to have that kind of dynamic with the broker. If you change every single year, you're never going to be able to build that dynamic, and your premiums are going to go up, your coverages are going to be terrible, and it's just not the place that you want to be. Switching is not the option if you want a cheaper policy. Sometimes the reason that you want to switch is because the broker is just bad, but that may not always be the case. You always want to make sure that you're thinking about that before doing the switch. Great, so we learned a lot so far in this video, and let's go over a summary of what we've learned. Number 1 is coverage gaps leave you exposed. We don't want them. 2, we learned how denied claims happen in the first place and how to avoid them. Number 3 is low limits that don't cover big losses. And we talked about having a proactive broker that goes over everything with you every single year to make sure that your coverages are at the places they're supposed to be in terms of the size of your business. 4 is having unresponsive brokers who waste your time, slow turnarounds for COIs, don't answer your questions when you have them, don't answer your emails, want to avoid those as well. And then we went over higher long-term costs from frequent switching of your brokers. You don't get to build your relationship with a broker. You never build trust with them. You destroy your relationship with carriers because you have multiple different brokers send out quote requests to the same exact carriers with different types of information, and it just makes you look bad, gives you a higher premium for lower coverages because now the carriers don't trust you, and it's just bad business altogether. You want to stick with a good broker for as long as possible, and if you don't have a really good broker, that's the only time when you would actually want to make the switch. And that brings us to the end of this video. Again, if you don't have a good relationship with your broker, if they are dropping the ball in any way and you need someone that's a little bit more proactive, then visit quotes.commercialinsurance.io/total risk protocol and let's see if we can help you out. Thank you for watching this video.